and welcome to On the Record. I'm Shireen Bhan. The Indian hotel and hospitality industry is hoping that the recovery that it's in the midst of is going to be a resilient one, given that we are at the start of the festive season. A stock that's been a clear outperformer is Indian hotels. If I take a look at the performance just in the month of September, it's up 15%, and this year it's up 81%. So the market is clearly excited about the strength of this recovery and the resilience of this recovery. To talk more about that, joining me now is Puneet Chhatwal of Indian Hotels. Puneet, always a pleasure. Many thanks for joining us here on CNBC-TV18. So let me start by building on that. You had a great Q1. Is the recovery sustainable? How resilient is it looking at this point in time?
Well, firstly, the sector has proven its resilience despite COVID. And within the sector, we are the largest hospitality ecosystem. And I think we are very well positioned to take advantage of what I say the best is yet to come. As you mentioned, the festive season is ahead. And with the G20 planned as of December, with India getting the leadership, I do think there'll be some kind of incremental demand, which we don't have in normal years. So, yes, given our new brandscape or the reimagined brandscape, given our diversified portfolio, I think we are very well positioned to take advantage of the increase in demand.
You know, I'll talk about the G20 advantage that you spoke of in just a second, but let me address the demand issue at this point in time. Q1 occupancy at about 70%. What is the situation that you are foreseeing at this point in time?
Well, the occupancies are maintaining good levels. So typically Q2 is the weakest of the 4 quarters. But with whatever I know, and we are just 2 days to the closing of the quarter, what we are aware of in terms of top line, I think it will be as positive as we could have expected it to be, as for the entire sector. And within that, as I said, we are a large ecosystem. We have had a very good, not like-for-like growth. So we are not expecting it to be, weak in any form. I think it should be one of the better Q2s that we have witnessed as a hotel industry in the last 5-7 years.
Okay, so significantly better than the rates that you saw in Q1, or moderately better?
No, I think what I'm saying is it's holding up quite well.
Okay.
Normally it is the weakest. So if it comes as close as possible to Q1, then that's good news for the industry.
Okay. What about ARRs? Because we've also seen a growth in ARRs year on year. That holding as well, and do you believe that you will be able to do better on that metric?
Going forward, I would say the Q3 is really the decisive quarter. It's always been the best, the strongest, because of the festive season, followed by the wedding season, followed by Christmas, New Year, everything happens for the best in our industry in Q3. So I think the rates and the increase in rates, we will have to wait till November to see if that's moving in that direction. My personal opinion is it will. We have room to grow. We have room to grow since not now, since not post-COVID, but for the last 10 years. And the kind of quality of hotels we have, the kind of service we provide, the kind of offerings we have the ability to charge, but we have not really seen that as much as we are seeing it now. So I think all the brands, the sector per se is demonstrating the ability to charge higher rates.
So how much pricing power can you exercise at this point in time, given the demand environment?
I definitely feel that on the business side, leisure is strong. It's, for our portfolio, it performed at 15,000 rupees, let's say. And business was at 10 to 12, and I think there is no reason why that should not hit 15 in the months to come.
Okay, let's talk about international travelers, because the restrictions have been lifted. But as we heard from the secretary, we were speaking with him earlier today, he said it's only been a trickle so far. Do you worry about the fact that given the global environment, the possibility of a recession, that trickle is likely to continue to be the trend and not turn into the deluge that industry was hoping for?
But Shireen, for the lack of better sentence, which I've used with you on your channel several times, I think this too shall pass. So, of course, shutting down is an easier decision. When you reopen, it takes time to kickstart any business, any industry, any sector. So I think with the October to March is typically when you get the international tourists, so it may not happen as much in October, but I'm very optimistic that as of November or at the latest as of January, February next year, that international travels will start coming back on the leisure side. On the business side, it's already coming. I mean, we have had a lot of global CEOs already visiting India in September. So that's been good news. And recently there was a JP Morgan Congress also in Delhi. So I do think that's business travel has started. The flights are full. The airfares are, very high. But of course, the number of flights is less. So at some point, the demand and supply will balance out, and we will get to see more and more people coming in.
Let's talk about supply. You talked about G20. What we are seeing at this point in time is that the hotel industry has the appetite to grow, but not quite the financing ability to be able to grow and deliver on the kind of supply requirements. Yours is a different story in comparison to many others at this point in time. But this supply-demand mismatch, how do you see it panning out? And is that invariably going to mean good news for at least branded players like yourself if there isn't additional supply that comes into the market?
Well, I would like to state it differently. As long as demand continues to outpace supply, your pricing power will be strong. If supply does it the other way around, it outpaces demand, then the rates are always under pressure. So at the moment, given what has happened in the COVID times, I definitely feel demand will outpace supply in the major metros. But there is a strong need, given all the schemes the government has put in for development of infrastructure, with the Project Udaan, with the new airports, with the Prime Minister Gati Shakti scheme. So I think all these would require a lot of infrastructure development, which is also the focus on the last budget that we had. And the indirect beneficiary of the infrastructure investment is obviously hospitality. And a lot of hotels need to be built in tier 2, tier 3 cities. And I think it's a good opportunity for the sector. Should we get the amendment in the infrastructure status, which we have been lobbying for, requesting for, asking for a few years now. For some reasons, it's limited to a population of 1 million. Should that get changed and amended, because it's based on a 2011 consensus, I think it gives you cheaper loans and a longer moratorium period. And at the same time, if the sector gets the industry status in the different states, some states have given it, but if others follow, I think that will improve the investment appetite in the hotel sector, and which will help in phenomenal job creation.
We'll talk about job creation in just a second, and the dichotomy that we are seeing in with respect to human capital for the hospitality sector in a second. But I just want to address the pipeline issue with you specifically. FY23, a pipeline of about 8,000 plus rooms is what I understand you're looking at. But given the G20 advantage, could this number look very different?
Well, G20 is around the corner, and hotels cannot get built overnight. Sure. So I think what could be different is maybe getting some mobile accommodation or tented accommodation. Luxury tents is possible to do that in a shorter period of time. But our pipeline and managing the pipeline is a very strong focus for the management. And our 8,000 pipeline can only increase, but it will not, become less. And we've been opening a hotel a month. This year we've already opened 6. But based on all the knowledge we have today, we should open 2 hotels a month in the second half of the year, which means another 12, which takes the total to 18, which means 1.5 hotels a month. And I think that's a very good pace given where we are coming from. As a legacy company with over 100-year history, I think this is not the way we have grown. And a lot of this growth is coming in different segments. And at the same time, if we add homestay business to it, we just signed our 100th homestay under the Ama brand, I think our growth and our pipeline is very robust and very good because most of it is driven by fee-based business.
I wanted to address the issue of consolidation, especially within the branded space, as well as the attempt to bring unbranded into the branded space. Do you have the appetite to play consolidator in this market?
Well, to some extent, we have been playing
Yeah.
because a lot of our pipeline is not new build. So currently, 30% of our pipeline is based either out of existing hotels, which are getting remodeled into one of our brands, or they are brownfield sites where, the construction was 60, 70% finished. But going forward, as distribution becomes more and more sophisticated and sales and marketing and digitization, I think some of the consolidation will be a consequence of that. And with our brandscape, we are, as I said, very well positioned from Ginger to Vivanta to, Selections having a collection of hotels. But we'll try to keep Taj as pure, as iconic as it has been for the last 120 years. So that part, will not just pick up a hotel just for the sake of, increasing the pipeline. So Taj remains the backbone, the most iconic brand India has produced. So that definitely no, but consolidation at a different level, at a different segment, yes, we are well positioned to take advantage.
You talked about the management fee, and I want to understand from you what the trajectory as far as new initiatives and new revenue streams are concerned. We've already seen that grow. What is the expectation on that front?
Well, we expect to double our management fee income from a pre-COVID level in the next 2-3 years, which is very good because management contracts are considered as the sweet spot of the industry. And that is the change in business model that has been driving our margins. So when there is an upswing in the cycle, you benefit from both. You have the operating leverage in your owned and leased portfolio because things are looking good and things are going up. At the same time, you have the benefit of management fee income coming in, which drives a higher margin because you don't own the P&L. So that is one of the reasons we have given the guidance under Ahvaan 2025 that we would want to aim for 33% EBITDA margin.
Yeah.
That's an aggressive number, knowing that between 2010 to 17, our average EBITDA margin for the year was like 13-14%.
Yeah. So that's exactly my point. To go from 10 to 13%, which was the decadal average, now to the guidance of 33%, what are you doing differently to be able to deliver on this performance, to be able to deliver on this growth?
The strong growth is one. So when we went for Aspiration 2022, which we stopped because of the COVID, we gave the guidance of going to 25%. By the time we were in COVID, 19-20, we had hit 24.8%. So almost got to 25% EBITDA margin. And now post-COVID, with all the properties that we have added to our pipeline, with all the openings that are coming in, with all the optimization of costs, with the increased revenue coming in now, the renovations, the upgradations of a lot of hotels to Taj level, almost 20 of those, that includes the Fish Cove, the Holiday Village, the Fort Aguada, the Taj Mahal Lucknow, they were all upgraded, renovated. Number 3, our focus on Ginger, which is a high margin business. So we classify the reimagined Ginger, the Ama and Cumin as our new businesses, including the private membership club reimagination of the Chambers. And these are very high margin businesses. All of them deliver north of 35%. Chambers, the membership fees could deliver up to 85% margin. Our QSR and Cumin home delivery has always done north of 40% margin. Ama, our homestay, does 60% margin. So even though they are small, as a percentage, they take the average up. And that has been a part of a business decision we took and the strategy that we communicated and executed during COVID times exactly in the same way as if we were doing it in a pre-COVID time.
We'll take a break here on the Record and continue our conversation with Puneet Chhatwal of Indian Hotels when we return.